Hello and welcome to our video on short selling. Today we'll be discussing what short selling is, how it works, and the pros and cons of this investment strategy. What is short selling? Short selling is a trading strategy where an investor borrows shares of a stock that they believe will decrease in price, sells the shares, and then buys them back at a lower price to make a profit. The investor profits by the difference between the price at which they sold the shares and the price at which they bought the shares back. How does short selling work? Let's use an example to better understand how short selling works. Suppose you believe that a certain stock is overpriced and that its price is likely to fall in the near future. In this case, you can borrow shares of the stock from another investor and sell them in the market. If the stock price does fall, as you expected, you can then buy the shares back at the lower price and return the shares to the original owner. The difference between the price at which you sold the shares and the price at which you bought the shares back is your profit. However, if the stock price rises instead of falling, your losses would be unlimited, as there is no limit to how high the stock price can go. Short selling is also a more advanced trading strategy and may not be suitable for all investors. It requires a good understanding of financial markets, as well as the ability to effectively analyze and predict stock price movements. It's also important to note that short selling is heavily regulated by financial authorities to prevent market manipulation and excessive risk-taking. For example, some countries have restrictions on short selling during certain times, such as after a stock has fallen significantly in price. Another important factor to consider is the cost of borrowing shares. Short sellers must pay a fee to borrow the shares they need to short sell, and this fee can add up over time. Additionally, the cost of borrowing shares can also increase during periods of high demand, making short selling even more expensive. Finally, it's important to have a well-defined exit strategy when short selling. This means having a plan for when to cover your short position and buy the shares back. Without a well-defined exit strategy, short sellers can end up holding onto their short positions for too long and incurring significant losses. Pros of short selling. One of the main advantages of short selling is that it can provide an opportunity for investors to profit from declining stock prices. In a bear market, short selling can be a useful tool for investors looking to protect their portfolios from losses. Short selling can also serve as a way to hedge against potential losses in long positions. For example, if an investor holds a long position in a stock, they can offset any potential losses from that position by shorting a similar stock. Cons of short selling. One of the biggest risks of short selling is that the losses can be unlimited. If the stock price rises instead of falling, the investor's losses would increase. Another risk of short selling is that the shorted stock could increase in price due to short squeeze. A short squeeze occurs when investors who have shorted a stock start to buy it back to cover their positions, driving up the price of the stock. Conclusion. Short selling can be a useful tool for investors looking to profit from declining stock prices or hedge against potential losses in long positions. However, it is important to thoroughly research and understand the risks involved before attempting this investment strategy, as the losses can be unlimited. Thank you for watching our video on short selling. We hope you found it helpful. If you have any questions or comments, please feel free to leave them in the comments section below.